Welcome to This Explainer. If you've spent literally any time on social media lately, you've probably been completely bombarded by finance influencers shouting buzzwords at you. Index funds, mutual funds, hedge funds, ETFs. It honestly feels like a totally different language, right? Like it's designed to make investing seem exclusive and out of reach. Well, today, we're cutting right through all that jargon to build your understanding of pooled funds from the ground up. Here's our roadmap for today. We're going to cover 1. What is a fund? 2. Index funds. 3. Mutual funds. 4. Hedge funds. 5. ETFs. And finally, 6. The final verdict. Okay, let's dive right into this. Section 1. What is a fund? The birthday party. Before we even think about touching the stock market, Wall Street, or ticker symbols, we have to ask the absolute most fundamental question that practically everyone glosses over. What exactly is a fund? We use this word all the time, right? But if you strip away all the fancy financial lingo, how does it actually work? Imagine you and your friends want to throw an epic birthday party. Now, if one person bought absolutely everything, it would be insanely expensive. Instead, everyone chips in $20. With that pooled budget, you buy the food, the drinks, the decorations, and of course the cake. No single person has to carry all that financial stress. That's exactly what a fund is. It's just a group of people pooling their money together. Then, professional systems take that giant pot of cash and invest it across hundreds of different assets, like stocks or real estate, basically doing all the heavy lifting for you. Moving on to Section 2, Index Funds, the scoreboard. So you've probably heard finance creators tell you to just throw your money into an index fund and forget about it. But why exactly? Well, it all comes down to passive management. See, an index fund doesn't rely on some human manager sitting there trying to guess which stocks are going to be winners. Instead, it relies on an algorithm that acts kind of like a scoreboard, just copying a specific list of companies. For example, if you buy into an S&P 500 index fund, the fund is literally just tracking the 500 biggest companies in the US. It's automated, it's calm, and it's totally passive. And because it's passively managed by a computer algorithm rather than some highly paid Wall Street professional, the fees are microscopic. We're talking 0.02%. Fees for index funds typically range from 0.02% to maybe 0.20%. To put that into perspective, in real terms, you're often paying just a few cents a year for every $1,000 you have invested. They're super low effort, they're low cost, and historically speaking, they perform incredibly well over the long haul. Climbing the ladder of complexity now, here's Section 3, Mutual Funds, Active Management. Now, on the surface, mutual funds look a whole lot like index funds, right? They're both giant pools of money. But the big twist here isn't how they're managed. If you contrast the passive, smooth-running algorithm of an index fund against a mutual fund, you get active management by a human professional. This is a real person who is often super stressed, staring at charts all day, trying their absolute hardest to beat the stock market rather than just copy it. I mean, it sounds great in theory, having an expert at the wheel, doesn't it? But here's the catch. Active management is incredibly expensive, which brings us to a crucial number, 1.5%. Mutual fund fees can range from 0.5% all the way up to 1.5%. That's often 10 times higher than index funds. You're paying a massive premium for that human expertise. And here's the truly fascinating part that the data actually shows us. Despite those high fees, most active managers fail to consistently beat the market anyway. So generally speaking, you'd really only use a mutual fund if you strongly pressed a specific manager's specific strategy. All right, shifting gears, Section 4, Hedge funds. High stakes. Hedge funds exist on a completely different playground altogether. Now, despite having the word hedge in their name, which usually implies safety or protection, these funds are all about chasing massive, massive returns. They do this by using highly aggressive tactics like borrowing huge sums of money or engaging in short selling. And because these tactics carry literally astronomical risks, these funds are strictly off limits to the general public. They're reserved exclusively behind a velvet rope for accredited investors. That basically just means institutional wealth or very, very high net worth individuals. And this brilliantly illustrates the crazy cost of entry for that high-stakes club. It's known in the industry as the 2 and 20 rule. If you want a hedge fund to manage your wealth, you are going to pay a massive premium. They charge a 2% management fee every single year just to hold your money, and that's whether they make you money or lose it. On top of that, they take a whopping 20% cut of any profits they generate. It is incredibly high risk, massive volatility, and incredibly high cost. Let's bring things back down to earth for Section 5, ETFs, the hybrid solution. ETF stands for Exchange Traded Fund. I really want you to think of these as the ultimate hybrid vehicle. Let's break down exactly what that means. Just like an index fund, an ETF gives you instant diversification. You put your money in and boom, you instantly own a tiny piece of hundreds of companies. But just like an individual stock, ETFs trade live on the stock exchange throughout the entire day. Unlike mutual or index funds that only settle their prices once a day after the market closes, ETFs give you real-time price control. It's extreme flexibility combined with the safety of diversification, all with those sweet, very low fees. And that brings us to Section 6, the final verdict. When we line up index funds, mutual funds, hedge funds, and ETFs side by side, the contrast is pretty stark. You've got the massive fees and high risks of hedge funds, meant only for the ultra-wealthy. Then you have the active management of mutual funds, carrying higher fees without any guaranteed performance. For the everyday investor who is just looking to build long-term wealth, the simple, safe, and low-cost nature of index funds and ETFs generally makes them your absolute best bet. They let you participate in the growth of the market without getting eaten alive by fees. We've pulled back the curtain today on how these funds operate and exactly what they cost to own. Understanding where your money goes and who is taking a cut of it is absolutely the single most important step in taking control of your financial destiny. So I want to leave you with this question to think about. With the fees finally exposed, which fund are you going to choose to build your future? Thank you so much for joining me for this explainer. I really hope it brought some serious clarity to your investing journey.